Greetings, members one and all of the Salivation Nation. Why the US dollar could fall faster and harder. Let's explore. Yes, I've sort of changed the title a little bit, as you can see from this article from scmp.com. This is an opinion piece by Stephen Roach on why the US dollar is only going to fall faster and harder. But it is opinion, but there's a lot of things to keep in consideration here, and also why we should protect ourselves for this particular incident, and especially what's been going on here in the United States of America. He says, given the unprecedented erosion of domestic savings, an explosive current account deficit, and the Fed determined to keep rates flat, expect the dollar to plunge by as much as 35% in 2021. In fact, here is indicative by part of what I talked about in my prior video about we are on the brink, is this is a picture of a broken Statue of Liberty figure amid glass shards from a looted souvenir shop in New York City after a night of protest in early June over the death of George Floyd. The article goes on here and says that the US dollar slide has entered the early stages of what looks to be a sharp descent, having already fallen by 4.3% in the 4 months ending in August in terms of real effective exchange rate, the index that matters the most for trade, competitiveness, inflation, and monetary policy. Keep in mind the Federal Reserve targets inflation at 2 to 2.5% now, and by these other measures, the dollar has fallen by almost double that. The recent pullback comes after its nearly 7% surge from February to April, when the dollar benefited from flight to safety triggered by the COVID-19 economic shock. We remember that well. That was when gold took a pretty big hit and silver plunged to $12 an ounce in the exchange-traded funds and futures markets. But even with the recent modest correction, the dollar remains the most overvalued major currency in the world. Now remember, it is utilized for transactions between 60% of all the nations around the world. The author, Stephen Roach, continues to expect this broad dollar index to plunge by as much as 35% by the end of 2021. This reflects 3 considerations: the rapid deterioration in macroeconomic imbalances in the United States, the ascendancy of the euro and renminbi as alternatives, and the end of the aura of American exceptionalism that has given the dollar Teflon-like resilience for most of the post-World War II era. I remember Bretton Woods was set up in 1944, and that essentially tied the dollar to gold. But the dollar was the world reserve currency at the time, and the dollar was tied to gold, but not directly. So in other words, other nations could trust in the dollar, which was tied to the gold that we had taken and basically, or we had stored for many European nations and around the world. Anyways, the first factor, America's mounting imbalances, is playing out with a vengeance. The confluence of an unprecedented erosion of domestic savings and the current account deficit is nothing short of staggering. For the first time since the 2008 and 09 global financial crisis, the net national savings rate has entered negative territory, as minus 1% by the second quarter, and it did so at speed, falling by 3.9 percentage points from the previous quarter, the sharpest plunge since records began in 1947. So what triggered this unprecedented savings collapse is no secret. The temporary surge in personal savings sparked by COVID-19 has been more than outweighed by record expansion in the federal budget deficit. The Coronavirus Aid, Relief, and Economic Security, which is the CARES Act, featured $1,200 relief checks to most Americans and a sharp expansion of unemployment insurance benefits. This boosted the personal savings rate to an unheard of 33.7% in April, but this quickly receded to 17.8% in July, and is set to fall more sharply with the recent expiration of expanded unemployment benefits. So offsetting this was a $4.5 trillion annualized widening of the federal deficit in the second quarter on a net savings basis to U.S. $5.7 trillion, which swamped the U.S. $3.1 trillion surge in net personal savings. With the federal budget deficit exploding towards 16% of gross domestic product this financial year, according to the Congressional Budget Office, the savings plunge is only a hint of what lies ahead. So here we can see the growth, and we can see the 2020 deficit so far, $2.744 trillion compared to prior years. Look at that. In the 2019 deficit, they've been growing each year, and this is before the coronavirus hit, but they've been growing each year. Wow, pretty amazing. This will trigger a collapse in the U.S. current account deficit. Lacking savings and wanting to invest and grow, the U.S. must import surplus savings and run massive external deficits to attract foreign capital. This was confirmed by recently released second quarter international transaction statistics. Reflecting the savings plunge, the U.S. current account deficit widened to 3.5% of GDP, the worst since the 4.3% deficit in the fourth quarter of 2008. This widening of the deficit by 1.4 percentage points from the previous quarter is the largest deterioration since records started in 1960. Like the savings collapse, the current account dynamic is unfolding in ferocious fashion. With the net domestic savings rate likely to reach a record depths of minus 5 to 10% of national income, Stephen fully expects the current account deficit to break its 2005 record of 6.3% of GDP. Driven by the explosive surge in the federal budget deficit this year and in the next, the collapse of domestic savings and the current account implosion should unfold at near lightning speed. It is not just the rapidly destabilizing savings and current account imbalances that are putting downward pressure on the dollar. A shift in the Federal Reserve's policy strategy is a new and important ingredient. By moving to an approach that now targets average inflation, the Fed is sending an important message. Zero interest rates are likely to persist for longer than previously thought, regardless of any temporary overshoots of the 2% target. That's right. So they've been very transparent that they're okay with higher inflation, and they're going to keep rates near zero. This new bias towards monetary accommodation effectively closes off an important option. Upwards adjustments to interest rate that has long tempered currency declines in most economies. By default, this puts even more pressure on the falling dollar as a escape valve from America's rapidly deteriorating macroeconomic imbalances. In other words, modern monetary theory. In short, the vice is tightening on a still overvalued dollar. Domestic savings are plunging as never before, and the current account balance is following suit. Don't expect the Fed focus more on supporting equity and bond markets than on leaning against inflation to save the day. The dollar's decline has only begun. By the way, he's a faculty member at Yale, and it is certainly interesting commentary on this. I mean, this is written without the hope of a second stimulus package, but now that has been revived. I heard an interview with a South Dakotan congressman saying that some of them have revived talks, and there may be some chance of another stimulus or relief package, is what they call it, coming in coming weeks, or maybe even after the election. We shall see. But nonetheless, that may be one of those things that kicks the can down the road, and obviously it's going to increase deficits and spending even more, for sure. But with the increased debt out there and with what's going on, It's certainly is scary to think about. But I do believe that if things do turn around in the economic situation, especially with COVID and things move in a positive direction, and there's a vaccine that can be distributed logistically that enough people feel confident in taking, then that could ease the markets, and that could potentially cause some real economic hope out there, and which could in turn turn things around and save the dollar, and maybe the Fed will rethink its course of direction over the next couple of years here. But it's tough. The further we go into this uncertainty, and the further we go with what we've been doing for as long as we have, with increased rates of the coronavirus and increased economic uncertainty and people being scared and joblessness. There's other sectors of the economy that are recovering, but nonetheless, the longer we go in stagnant levels, the more the dollar is in trouble. And this is why we hold gold and silver. This is why we stack them. And that is something that is obviously the ultimate safe haven, are these precious metals, compared to the dollar that could potentially go in another direction. But to think about it, and here's another area where I do disagree with the author on this, is that the dollar is going to fall faster and harder. Well, so will the other currencies too, because all the other nations are doing the same thing, and they're hit hard too. England right now, the United Kingdom, is dealing with another round of this, and they've put in some pretty tough restrictions on folks there. And so this isn't just in the United States, but I doubt very seriously the renminbi is going to save anybody, or the euro, as we go through these situations, and as this pandemic continues, or at least the perception of it and how the market reacts to it. People have different viewpoints on it, and I don't really necessarily want to debate that in this video, but nonetheless, it's the perception of the marketplace and the economy in general of what is going on, and that is what is affecting all these things. We'll see how it plays out. Either way, no matter what you're feeling about what the dollar is going to fall faster, obviously by design, it's degrading every year by at least 2% under a normal economy. So I think that's the reason why we hold precious metals, for that very reason, because in the long run, they will preserve our wealth. And that's the best thing we can hope for them. And this article is just another reason why we hold them. So there you go. Post your thoughts in the comment section below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.